So the story of the day was negative crude oil prices. Very, very interesting development. Meaningless in terms of like whether or not we make money or not on it, but interesting because it's a reflection of some other divergences that we're seeing in different asset classes in conjunction with equity, specifically in conjunction with the NASDAQ 100 stocks. So I'm going to break down a lot of those relationships. There's some little bit of red flags, small, not significant in terms of like 30% drop again, but there's some little bit of red flags that are popping up from a technical perspective that we shouldn't see if we were now coming off of the low point and rallying higher. So I'm going to break down what those are. And then we're going to take a look at a familiar name to a lot of you for our trade idea of the day. It's showing a very fascinating pattern on its chart. So we'll talk about how to trade that pattern. Let's go ahead and get started. Today is Monday, April the 20th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator here. As you can see, the intermediate posture is still rising. The intermediate line is still rising. That means we have dark green shading here on our chart, even though we have a yellow line. So we still don't have that good combination of dark green shading and a green line, which is a bullish combination here. But you also see that the longer we stay up above the moving average here, the more likely we are to rally. Now, that's not the case for some of these others, right? I mean, the Russell 2000 here, as you can see, is barely above its 30-day moving average. So it's not going to be turning up anytime soon. Of course, the NASDAQ Composite's the one that's closest, and QQQ, which is the large caps in the NASDAQ Composite, has already turned up. So, and you can see the Dow Jones Industrial Average doesn't quite look, not quite there yet either. So still a pretty steep decline versus the S&P, which is now got a nice steady, slowing down here. Obviously, you can see the momentum line here dropping to, let's get rid of this, dropping to really, really low levels. That would be an extreme low point to the downside. So, again, that can be a kind of a canary in the coal mine, so to speak, in terms of trend changes. When you get a extreme low in the opposite direction of a trend. So, keep that in mind. Of course, we closed below yesterday being the highest point, had the highest high. We closed below yesterday's low point, but we've done that before. We did that over here. So that's not necessarily 100%. Nothing ever is 100%, but it's a bearish signal nonetheless when you have that type of close. The near-term line, as you can see, is not getting in the reversal zone, is slowing down its ascent. If it peaks here without getting above 80, that would be bearish. But that would be bearish to an extent. It would be more bearish if we had a lower high, but we'd have a higher high, and that actually would set us up for bearish divergence, where you get lower highs on the indicator on the blue line here and higher highs on the index itself. So, of course, that sets us up for, again, you break through this level here, which would be the low point in between those two highs, and then that would be your trend change from that perspective. So a little bit of a canary in the coal mine with the red line, and then the confirmation. You got a little bit of confirmation with the close below that yesterday's low, but then the real confirmation of a pretty of a decent down move would be breaking through that area here, filling in the rest of this gap, and then breaking into that area. So otherwise, you can see a Harami pattern forming here on the Russell 2000 after such a bullish candle there. This would not be a divergence. This would be a lower high point with the near-term line getting in just as of right now, one day into the upper reversal zone. Of course, your diamonds, again, the QQQ is so bullish that its intermediate line's already above 80. Came really, really darn close to a cluster, to a overbought cluster. Would have gotten an overbought cluster. I say that. I say that now. Like, it would have gotten an overbought cluster if we had opened up down here and rallied higher. That made me think of the old Scooby-Doo episode. It would have got a cluster too if it wasn't for those meddling kids. But it didn't. But it came pretty darn close. So to have the intermediate line already above 80 is pretty significant. Again, when you look at comp, which is the composite. It's briefly dipping its toe above 80. So, it's really taken off, whereas nothing else. I mean, the Dow's struggling, the Russell's not even above 50, and that's the thing here. It's in dark pink, light green shading mode. Whereas everything else has been pretty dark green shading for a while, and we're not getting that confirmation in the broader market and those smaller cap stocks. I did find this chart interesting. This is a comparison chart of IWM to SPY since the March 09 low point. You can see small caps pretty much led the way up off of that low for a good long time, because a lot of people said, hey, the small cap stocks maybe. In fact, this was an interesting tweet right here. For those who follow me on Twitter, I posted this out. Anytime you hear that, again, like it says, that small caps are severely lagging NASDAQ 100, that's what Index is. As stocks recover from the sell-off, can we expect the flight into large cap tech names to continue? Danny Kirsch says, not necessarily, but it's likely the small cap tech divergence is here to stay. Anytime you ever hear a parabolic move talked about as now being here to stay, that's usually a really good sign that it's not here. I mean, that's usually kind of like the Barron's magazine cover indicator. I mean, that's when people start talking about, oh, now this relationship is, it's going to now be the same. Last time it was talked about never, changing was in the tech bubble, when all these tech stocks were doing so well, and you can see what happened over here when that bubble burst. Well, we're now forming another bubble here, as you can see with the standard deviation of this relationship at the top. That's a significant breakout move here. This is a bubble move. It's just, it is what it is. Look at the RSI on the weekly chart. Look how high the RSI got. Got all the way up to 90 on the RSI chart. So when you hear stuff like that and you say, oh, the small cap stocks, maybe now the economy doesn't. I mean, everything's going to run without them. Well, that's not the way it's been. And just because we're in a bubble now doesn't mean that that's a new normal. In fact, a lot of times when we expect a new normal, we get a correction, right? We get a correction back to the actual relationship, which is smaller companies, smaller businesses, grow our economy, lead our economy. As you can see, again, coming off of that March 09 low point. Look at all these. In fact, if you go all the way out, here briefly you had very comparable returns at the very bottom, but then even after that, you can see how the gap grew again in terms of outperformance in small caps, and then we pulled back, and small caps pulled back, and their returns got pretty similar. But look at the move off of that low point. Small caps took off away from large caps until you can see here, very briefly, the S&P 500 had a little bit of a gain. Again, off of the 09 low point, the S&P 500 finally eclipsed the returns of small cap stocks from there. And of course, you see what happened. Now, granted, that's not the reason. It was coronavirus. But again, the reason why this move was as big as it was is because of the technical environment we were in February. That opened us up to that possibility. If the market wasn't so overbought, as is one of the relationships here, then we wouldn't have had such a stark sell-off. We would have had something like maybe like 2011 or something like this. This is the Ebola sell-off, right? Obviously, that wasn't nearly as extensive. It was pretty scary when that was going on. We would have had something like, like these kinds of sell-offs, but we wouldn't have had that, right? Third biggest sell-off, really close to number 2 sell-off. I mean, that was like the Michael Jordan of sell-offs, with the 1929 being the Sam Bowie of sell-offs, right? That really, I mean, for Portland, it might as well have been the Great Depression, having drafted Sam Bowie over Michael Jordan. But this is the Michael Jordan of sell-offs. 34% in 4+ weeks. That's a tremendous move. We wouldn't have had if it wasn't for that technical environment. Now look at the gap, right? Now look at that gap. Look how big the gap is from the S&P to the Russell 2000. If you thought that was such an extreme move, look at that, right? And if I were to change this to this low point, was it February the 11th of 2016, it gets even more drastic. February 11 of 2016 up until now, Good returns on the small caps, exactly what you expect in a bullish environment. Selling off, it's exactly kind of what you'd expect. A bounce up, but you notice this move by large caps didn't look at the gap there that we filled. It didn't start there like it did when we came out the March 9 low point. It started over here. Small cap stocks pulled back in October. Large cap stocks didn't pull back as much, and they led pretty much most of that move, especially at the beginning of the year. So that's when the divergence started, and then that's where it corrected. And now we're doing it again, right? We even have that. I mean, it's almost twice as big as the returns as a small cap. That's not normal, and that's not healthy. And again, something to keep in mind on when we're talking about what kind of returns to expect going forward from here. QQQ is already close to those highs and very bullish because of that. IWM, not so much, and it might be a little bit more reflection of actual risk appetite. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you are watching us on YouTube. That will notify you when these videos are posted. Also, hit that thumbs up icon down there. That tells us two things. Number one, you liked our video today. And number two, you want us to do it again tomorrow. So it's a quick way to give us feedback. If you don't want us to do these videos tomorrow, then you don't have to click on anything down there. But if you do, we'd like to know, and let us know by click. You can do that right now while you're watching the video here. It's a big deal to us, so we appreciate those that do. Also comment down there. What did you get out of our videos today? That's something we like to hear too. Let us know in the comment section. Join our website at marketscholars.com. There's a link popping out top right corner of your screen right there. Click that link, takes you to a page. You can subscribe to our site for free. Follow us on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. If you're watching us on our website here, we invite you to check out some of these other things on our site. We have our class schedule over here on the right. We do 8 classes a week, 4 between the two of us each. You can get access to all 8 of those classes with our monthly plan. You also get access to our trade review video that we do on all our Market Outlook trades. We do those live at 3:30 Eastern time. Every day that I do the Market Outlook, I review all my trades. So you can be able to check that out. That's something we always get asked. In fact, that's the number one thing I've been asked for. So check those out there. And again, our premium subscribers get access to all that too, as well as all of our premium tools and resources, as well as our Q&A sessions that we have. So check that stuff out. We also have other blog posts over here on the right. We have our engagement here on social media. Click this heart. That opens us up. Click that like button there. Hit the thumbs up. That takes you to your Facebook page. Again, like our stuff there on those platforms, so that way Twitter, Facebook promote our content to your accounts. Right? They don't promote content. They don't push you all the content of all the accounts that you follow. They have algorithms that push you content with the accounts that you engage with. Where we try to make it really easy for you to do that here. All right, now let's take a look at our Hakinashi candles, and you can see what we have going on here. We are now flirting with the 50-day moving average here. Let me remove that. I actually need to get this. Give me 1 second. We need to get that line drawn, not this one. Remove that, but it's this one that we've been kind of watching. Actually goes, is it that? I think it goes a little bit further. Yeah, it goes out from this low point here. Trying to get all these. Let's see. It's more like, let's come here. Try to fit all these the very best that we can. All the lines in the middle. So we're kind of going through there, hitting that line is what we wanted to see. So as you can see, we're flirting with that and the 50-day moving average right now. From a Hakinashi, from a regular candle, we're just flirting with going back down below the 50. So keep an eye on that here this week. Obviously, we'd have to fall for us to get any kind of lower shadow on this week's candle, which is a smaller candle body so far than what we've seen. We'd have to fall to 27.14. That's over 100 points away. So more than likely, that's not going to happen. The question is going to be, where do we end up this week to the point where where we're going to open next week? What kind of candle we get next week? Are we going to get a reversal type candle here with a really small body, something like this or something like this next week? So that's something to keep in mind if we don't finish up above these highs this week, if we don't finish even near the highs this week. If we end up coming down that can lead us to a very neutral reversal type candle on this next week. Let's take a look at the 3 green arrow chart here. Obviously on the S&P 500, the MACD is dropping. That's not surprising. We are still rising, but we're doing with less momentum, and that's typical. That's what happens. Volume is tapering off. In fact, if you take a look at the 3 green arrows, stochastics are still in the upper reversal zone, but you notice we're flirting with dropping below the moving average of the stochastics, and same thing. The MACD itself isn't rising anymore. The histogram rolls first, then the MACD itself will roll and cross over. So these are some things to keep in mind. Eventually, when you get to high levels, when you have a lower VIX, then we just kind of grind up there. But we don't have a low VIX right now. We have a high VIX, which means expect volatile moves in either direction, as you'll see here in a second. So I don't expect us to grind around the moving average here, because that's not the type of volatility that the markets are exuding right now. All right, now let's take a look at the intraday chart, the 4-week range, and you can see how high up we are. Again, last week's close was the high of the 4-week chart here, and you notice now the 4-week low point, which is the March 23rd low, the low so far, that's off. That's way almost about to go off. So just in a couple of days, we're really going to move the low point up and start tightening up the range, which means that either we're going to pop up the new highs here and to keep the range going, or we're going to start to start flirting with the lower end of the range just that quickly. So keep that in mind. That's usually, if we're bullish, if we're going to maintain bullishness as this low rises, because it will rise in just a matter of days, it will rise from here to here to here, and then eventually it'll spend about a couple of weeks over in this area, right, from this low to that low point, and then make another jump. So by the time we get to these lows, and by the end of the week, if we're not pushing to new highs, if we're coming down here, filling in this volume gap towards these lows, if we're trading at 260 by the end of the week, then we're going to be flirting with 4-week lows just that quickly, just a bit below the midpoint of the chart and floor. So again, it's one of those things that usually this will push us up to new highs. So that's something to keep an eye for. If we get it, great. If we don't get it, then not so good, and that's where we'll expect to start coming in and filling in these gaps and so on and so forth. Obviously, the volume and the range today, not very much of a gap, very, very small range from what we've seen. Very low volume, 100 million. Just like that, we're down to 100 million shares, the lowest volume we've seen in a long, long time. As crazy as today was, right, with the crude oil doing what it was doing. So 5 points is well down here. Starting to bring this line down towards the 3%. Remember, this comes down first before we get the low point. So this will be down to 3%, and then we'll kind of grind towards the low again. So keep that in mind here. Obviously, we're not going to go up and come right back down. When volatility was as high as it was. Now that it's down here, then we expect, like we saw from December to March of 0809, to kind of more slowly come back down towards these lows, and most likely towards kind of this level here is what I would expect off the bat, 245. Volatility had an interesting move today. Within the markets, volatility was actually up quite a bit, going up to 43%, back above 105%. Again, this is high. These are high volatility levels. We don't really, we closed above the highs of the VIX for the last so many days. That's a pretty significant move here in terms of a reversal move, and I don't think it's done. I think we have a chance to go up in this area if volatility does make another run, right? Of course, it doesn't have to, because nothing's ever 100%, but I expect that we'll make another run towards 115%, because that's what we've seen in the past when we've had these big moves to the upside. We make another run towards 115% because we are still in this market sentiment pullback. Make another run maybe towards 50, 55, maybe up in the high 50s before rolling over again. So the fact that we closed today and the market didn't, another one of those divergences that's not so healthy for us to see. So from a technical standpoint, just to summarize before we look at some of these other charts like crude oil and other things, and then our trade idea of the day, From a technical standpoint, we've got a nice, good bullish trend, but there's some signs. There's some signs that are cropping up that we shouldn't see in a good bullish market, as I pointed out here today. So, another one of those things that David Keller also tweeted out, and that we've been talking about in these videos, is the RSI is not above 60. The CCI didn't jump above 200. So, we're not getting signs yet that we should see in a bullish market. We're getting signs that we shouldn't see. And so that's why I'm not, and they're starting to build up a little bit, and they were building up in February too. And I'm not expecting a 34% decline in 4 weeks, but I do expect that, that this little run that we've had is probably a little bit too overextended, right? It's all about getting people off that bandwagon, and it's got to make enough of a run to get as many people off that retest the lows bandwagon as much as possible, to get it to where people, whether or not they're shorting the market expecting to roll over, or they're still in cash expecting to roll over, and now they start to get in because they feel like they missed out. And in fact, I heard that today on TV. What do I do now that I missed out? Well, the more and more you hear that, the more likely you are now to get the rollover to the downside. And so you're starting to see some of those anecdotal signs, and I pointed out a few others to do on Twitter. So like I said, make sure you follow me on that for more content throughout the day. But that's my take. I expect now, with Expiration Friday behind us, that and more people not expecting us to pull back, at least not nearly as badly, to the point where they might not be bearish here. They might stay bullish or start looking for bullishness. That puts us in the environment. That puts us in the environment for some near-term weakness here, enough that we can bring that intermediate line back down again, especially from those large cap tech names. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click that link, opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that suggests either you're a lot more bullish than I am, or you're a lot more bearish, right? Whether we'll retest really quickly, or we'll go through those low, whatever. Let's share with us in the comment section what you're seeing that drives that opinion. All right, now let's go back to what's driving this price action. And of course, the big news of the day was what was going on in crude oil, specifically in the May contract with crude oil. And of course, that's a very illiquid contract, but it is telling. It in and of itself is not a big deal. But you can see pretty much since we peaked here on the 3rd, ever since that April 3rd peak in crude oil, crude oil is really stocks have kind of taken off from there. But in fact, this is from the March 23rd low point. If I were to go from that April the 6th, from the open of that day, you can see that stocks have gone pretty well. In fact, small cap stocks have done okay in the last couple of weeks, a little bit, and not as much. They initially did well, and then you can see large caps are above these highs, and small caps are well below these highs, and so is real estate, as you can see V and Q there. But look at the drop in USO since then. One little blip right there where we popped up, and so did equities. But since then, we've been on a steady decline to the downside. In fact, if you now go to the March 9th, which is that one blip, right, where we popped up to the upside. See, we started up, and we were up a few percent, and high yield was up, because again, they're kind of associated with each other. Well, there's been a big decline, and stocks are up, but so is gold, and so is high yield, and so are treasury bonds. It's been a little bit of a risk-off move since then, and largely driven by this big sell-off in crude oil. USO is an ETF that tracks the active contract, and so it's been kind of getting out of. In fact, you could see that here when it switched from May to June. That's when you saw the ETF kind of jump up. Did a little bit of a bounce up here, but it's been dropping, and it's dropped down today. Again, you look at the front. This is the June contract. You see how this is the continuous contract here, but when we jumped up to June, it jumped up from these $18 levels up here, and even that contract has been down, popping up a little bit here. So so in other words, like as bad as much as crude oil, today's move was kind of relatively inconsequential because it was the May contract. It was expiring, and it had to do with physical delivery. Very good explanations of that all over the place. The reality is the fact that we can't find any place to store is a little telling. And the fact that crude oil has been this bearish for this, dark pink shading, red line for this long is a little bit telling. And the fact that it's been diverging away from, even off of this 323 low point here. Here's the 323 where stocks rallied. Stocks have really gone up, QQQ especially, but crude oil really hasn't. And so, and not just crude oil. It's not just a crude oil story, right? Because 10-year yields haven't really gone off those 323 lows. So we started off a little bit, but now we're actually lower on yields than we were there. So we're seeing in other asset classes, dark pink shading and red lines in bearish territories that we're not seeing in equity, specifically because of this, dark green shading and green line. It's not too common for us to be so unbelievably negatively correlated in those asset classes. In fact, if you look here, and if I were to zoom out a little bit further, you can see for the most part, and this is just using the 12-day correlation similar to the typical 12-day rate of change time frame. There's brief periods of time where you have negative correlations. They don't last very long, but times where they have over the last so many years. The biggest time where we had a negative correlation, again, between QQQ and crude oil, again, not that they have anything to do with each other than the fact of risk appetite. Well, we really had a negative correlation at the beginning of the year. And of course, we know how that unwound, right? They both dropped, which is what this reflects. Now we're having, again, a pretty sharp negative correlation. Like here at 73%, 73.5%, we don't really get this low. We had a pretty negative correlation there in 2018 going into the fourth quarter where, again, QQ kept going up and crude oil didn't. And then, bam, you can see what happened after that period of, extended period of negative correlations there. So it's not really the best thing. And you can see, these are some pretty negative correlations. Even on that negative correlation, where Q's bounced up and crude oil obviously didn't. You saw, what happened after the environment that sets us up. It wasn't that relationship that caused the hard selling here. It's the environment of that relationship that sets us up for this type of selling. And the environment is being set up once again, where, it's not just crude oil. You can also see the same thing with gold, like the correlation in the 12-day period from gold and QQQ and what that looks like. And you can see, it's a pretty oscillating, goes up. There's zero right here in the middle of the chart. It goes up and down, up and down, up and down, short spurts. But when we have the longer runs, here's where, again, gold and NASDAQ 100 both went up together here at the end of the year, going into this part of the year, and then a little bit of a pullback there during the coronavirus issues that we had in China. But then the divergence, you notice, brought that correlation right back up to positive, and then whammo, they both kind of struggled there. But now look how, again, from this low point, it's been pretty highly correlated to see gold and QQQ together going up. And again, it's not your typical relationship, and not necessarily the most healthy relationship there. So we'll see if that plays out like it did for both gold and crude with the QQQs like it did at the beginning of the year. And that's the scare, right? Not that I expect a 30% drop in 3 weeks, but a move in risk aversion is definitely what these other markets are telling us that we're not seeing in equities, mainly because of the NASDAQ 100. All right, if you take a look at how the sectors are performing, lots of dark green shadings here. No green lines except for in one sector. That's your healthcare sector. It's part of the reason we've been pretty bullish here. Of course, you all know why. But you can see some of them that are not nearly as bullish, specifically some of these cyclical areas. Energy, it's struggling, but look at industrials and financials. Areas that you wouldn't expect necessarily to lead, these should be leading, and they've started to, not nearly as bullish as you can see as like healthcare is. But you know, look at utilities and real estate. I mean, a lot of these are just barely getting above their moving averages and have the opportunity to here pull back, especially, like I said, these light green shadings that are not even above 50 yet. But at least the nice thing is none of these are rolling over quite yet. There's no light pink shadings. All these dark greens will turn to light pinks. And the more we see that happening, then we know the reversal is coming about. The sector rotation chart, the comparison charts, kind of an interesting phenomenon too to take a look at, especially over the last little bit. Remember how crude oil kind of peaked there on 4.9, had that big bounce, and then we've been coming down ever since. Well, if you take a look at how the sectors have performed in the same time frame, so you remember crude oil popped up, see that energy stocks were up there. They've been down. Healthcare is not surprising or staying up there. Discretionary is staying up there. You still have some outperformance, but there's all your other cyclical areas. You know, economically growth sensitive areas in materials, energy, industrials, financials, all down. Utilities and real estate, which had been the market leaders during the ups and the downs here, are both down too. So now you can kind of see again what's lifting us up. You've got those staple companies, you've got the FANG stocks, and you have the healthcare sector. It's kind of keeping us bullish here, whereas all the other kind of more areas, aside from the interest rate sensitive sectors, utilities and real estate, all the other areas that are kind of sensitive to economic growth expectations are showing a pretty big gap in performance relative to the broad market as a whole. Boeing is one of those industrial names that's showing an interesting pattern. Obviously had the big decline, and then since it bounced and has been forming a triangle pattern. There's that market forecast pattern, light green shading and yellow line. We closed below that high point, but you can see it's a triangle, and the moves you have going into the triangle are typically the moves coming out of a triangle. From a technical standpoint, we had a downward move coming into this consolidation. You'd expect a downward move to come out of it. Maybe not to the same extent, obviously, because logarithmic scale, but you get the idea that it can be a pretty bearish pattern. If you take a look at its long-term, oops, not that chart, its long-term chart, you can see why we're kind of meeting up. Like, it's nowhere close to that 50-day moving average. It's still quite a bit down there, and then it has potential to trade within the ranges of these long lower shadows. You can see what the candles look like on this chart, right? There's, that's not even long lower shadow. That makes it even just as easy to trade inside of that range, because we were there. We were down in there throughout midweek. We bounced back up. So that's kind of tweezer bottom type pattern is like a long lower shadow. So keep that in mind. You also see from a Bollinger Band perspective, Boeing is sitting at its point of control in the 1-year chart. It's also sitting at that point of control in the 5-year chart. So you break down below here, there's not very much volume. The nice thing is if it breaks up and we're wrong, then we're going to have a really good trend trading opportunity to fill in that volume gap. I mean, it's not going to fill in 4 weeks like it fell. But you have a good opportunity for a run like this. See the initial move through this area occurred over here, and that took a year, right? It took 4 weeks to go back down. It took a year to go up. So if we were to get back into this area similar to what we did over here in early 2017, then that's the type of run that we can have filling in that volume gap. Otherwise, and as I mentioned, the downward potential is also just as strong. You're still in the lower half of the Bollinger Bandwidth. If you take a look at its Ichimoku cloud, it's still in a very strong trend. Obviously has earnings coming up, but you see a very, very strong trend here. This consolidation has not changed that pattern. If you look at its DMI pattern, you notice that its negative directional index is still above 25, even with the pullback. The positive has not been able to really clear it, and could potentially come back down below 20, according to that pattern. So you can see the bearish potential that the stock is having. It's moving averages converging on each other. MACD is still below 0, obviously still above its moving average, which is also below 0. The stochastics has crossed below its moving average. A little bit of a bounce towards it. We'll see if it will bounce off of it and run back down with the falling moving average there if it act as a resistance for it. So you see how the bearish potential is set up with that coming into that earnings season. So the trade that we did, again, we did this already in our Market Outlook live trade, is we bought the 115 put, which is out of the money, pretty decently out of the money, and we sold the 110 put to help cover the cost. And so what that trade looks like here, and we position size for half a normal position. So whatever your normal risk is, we cut that in half because of that earnings announcement coming up. So if it takes off up here to 180 whatever, then we'll get out with a small loss and then have that really good bullish trade opportunity. That will be a long-term bullish trade opportunity. Otherwise, if we come down here towards 110, then you can see the return opportunity 4-to-1 practically. About more than 3.5-to-1 risk reward in the worst case scenario. In best case scenario, we can get out early and cut it to about 7 or 8-to-1 reward to risk. So really good reward if we pull back, and a good long-term opportunity that will more than offset a small loss if it does pop up to the upside, which will. So even though I am doing a bearish trade, my bearish trade on Boeing, not on Russell, even though I'm doing a bearish trade on this right now, I definitely have my eyes on it with that earnings coming up with a bullish breakout trade opportunity for a longer term, not just May expiration, but for a longer term. All right, you've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our Market Outlook forums at marketscholars.com. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video down below. Follow me on Twitter for more content. Join our community at marketscholars.com as well as on Facebook. Again, thanks everybody for watching. Have a great rest of your Monday night, and we'll see you all tomorrow.